Good morning, everybody, and welcome to the second in this series of IMAC webinars, where we examine the issues and benefits of being a boutique manager, specializing in a particular asset class. On Monday, we focused on Australian equities. Today, Nigel Douglas, the moderator for this week's series, is going to take three leading international equity specialists through a discussion on the pros and cons of their asset class and their approach to them. Before I hand over to Nigel to introduce today's panelists, let me just talk a little about Friday's session, where we're going to have, Nigel is going to lead a discussion particularly focused on alternatives, but featuring three of Australia's leading portfolio managers, Dinya Irani from Innova, David Matesic from Atrium, and Shane Hawke from Portfolio Advisory Services. Three portfolio managers who've grown out of advice businesses. So we're going to talk about the advantages of being a boutique manager, let's say, particular focus on alternatives and their role in portfolio construction. Now, other events for 2023, we've got an action-packed year for 2023. When we come back in February, we'll have our week-long virtual Investec conference, Monday to Friday. Theme of the conference is technology and its role in sustaining a 20-year advice relationship. It seems to me that so much of the focus on technology has been about the creation of statements of advice. But of course, there's much more to technology in sustaining, making tangible, developing, and in fact, delivering an advice relationship over the 20 years that they typically persist. That's what we'll be focusing on in February. In March, our first live conference for the year, Portfolio Management Conference in Melbourne, Sydney, and Brisbane. We'll have an opportunity for 20 investment managers to talk about their particular asset class and the influences on their area of speciality. In April, the awards open and for a presentation in August, but I wanted to let you know that this year, for the first time, we'll have a boutique licensees class. We've had feedback from a number of the awards over the last couple of years. There's a real role for the focus on smaller advice businesses and the way in which managed accounts work for them. Moving on through 2023 in July, Advice in Action, the way in which practices and advice businesses should be thinking about the issues that they face, obviously with a particular reference to managed accounts, but not exclusively. And then in September, independent thought, which for me is a really exciting area that we've developed in 2022, an opportunity, as we'll see this Friday, for example, to showcase the expertise of portfolio managers and the really important role they play in the way in which managed account portfolios are constructed. So moving on, then the next thing I wanted to say, of course, is you're all experienced attenders of webinars. If you want to ask a question, and we do encourage you to ask questions, use the Q&A button at the bottom of the screen. And now it's my pleasure to hand over to Nigel Douglas of Douglas Funds Consulting to introduce today's panelists and to lead the discussion on the role of boutiques in international equity management. Thanks, Nigel. Over to you.
Thanks, Toby. As you mentioned, I'd like to formally introduce the panel. We have Hugh MacNally, Director and Founder of Private Portfolio Managers, Monik, Kotecha, Chief Investment Officer at Insync Funds Management, and Stephen Arnold, Managing Director and CIO at Aoris Investment Management. So to set the context, I'll start by asking the panel, what is their investment philosophy and how do you apply it to a managed account portfolio? Now, Hugh, can you lead off on this question, please?
Okay, thanks very much, Nigel. I guess there are two elements to PPM's investment philosophy. The first relates to return, and that is a focus on the return on capital that companies are generating. That's how we earn our return for our clients. We're not a trading operation at all. It's how the companies use their capital, and that's where we focus. The second element is how we manage risk, and there are two risks that we want to manage, and these we think make the most difference in long term. That if you avoid these two risks, you have a survivor bias, and you also have an elimination of the risk of repricing during periods of very high valuations. So in a financial sense, we're looking for companies that are financially very strong and able to withstand the inevitable periods of difficult economic times. And in valuations, we're looking for companies where the valuations are not aggressive. The reversion to the mean in valuations is brutal, and we think that avoiding excessively priced stocks, particularly in speculative times, gives a substantial advantage. How do we apply these to the two things? Basically, the portfolios are about 20 stocks. They're focused in developed markets where we've got long time series to look at of operating performance of companies. They tend to be in excess of 10 billion. There's no hard and fast rule, but in practice, they tend to be in excess of 10 billion in capitalization. And we don't hedge any currencies, but the stocks stand in the completely unhedged. We think that introduces a high level of unpredictability, and we don't know what the individual companies' own revenue streams are from time to time, and whether they're hedged themselves. So we don't do that.
Hugh, just briefly, how do you define long term? Because often clients can react pretty adversely or get upset about short-term underperformance.
Well, at least 5 years, and perhaps actually that in sort of later in the thing, might like to make a comment on the nature of the relationship between the manager and the client, and I think that's a very important part, that the expectations of the client are understood, and the manager explains what the range of possibilities, which are extremely wide, I have to point out, are, and how they manage them. So, but at least 5 years. It's not.
Okay, thanks. Monik, what's Insync's perspective?
Thanks, Nigel, and a pleasure to be on the webinar. So the foundational premise behind everything we do is that it's quite simple in one sense, is that share prices actually follow the underlying sustainable earnings growth of a business. And we've really found two key attributes that help us identify businesses that can deliver this sustainable and very high earnings growth well out into the future. And the first one is that they have to be very profitable. So you touched on return on invested capital. That is absolutely critical to every company we look at. So they have to be very profitable. In fact, if you look across our portfolio, the average return on invested capital is 40%. So we look for a very, very high returning business. That's 2.5 times the market average. And we've been told by consultants it's actually one of the highest amongst our peer group. So that's certainly a defining. Wanting to say it's one thing to say you're looking for high returns on capital, but we're looking for very high returning businesses. The other aspect is that that's all well and good, but it's about the future. So you need to have a runway of growth to reinvest it into to generate the earnings growth. So we look for companies that have a long runway of growth, and the way we seek to identify that is through identify mega trends, because that really gives us the confidence that the businesses that we invest in actually do have that runway of growth. So Insync basically investing in companies that can continuously reinvest their cash flows at very high returns, and we believe that generates the best compound earnings growth and shareholder results. So as a result of this very specific metrics and process we have in place, our universe of companies is actually quite small. It's around what we call 150 really special, very profitable businesses that have those tailwinds behind them. So we have the many sectors we seek to avoid because they just don't hit the metrics. So there's no financials, no resources. Get plenty of that in the local market if you're crazy about that. Cyclicals, no utilities, no telcos. They just don't meet the high bar. The other aspect is that these special businesses actually, whilst they're very profitable, they also have extremely strong balance sheets. So, in a high interest rate environment, it really doesn't matter to them. They've got the cash flow. In fact, many of our companies have net cash on their balance sheets. They generate an enormous amount of cash flow. And what this does is it provides those businesses the capacity to continuously reinvest right through the economic cycle. So yes, high inflation, whatever, they just keep going forward because their future continues to be bright. They spend on R&D and innovation. That's critical if you want to stay relevant, future-proof your business, continue to find new business areas. We're in a fast-changing world where they're well-positioned. And you know what? A lot of them pay rising dividends and or buy back a lot of their shares because they can. So the result of this from a managed accounts perspective is that we have a diverse portfolio of 30 stocks that are typically industry leaders. They're very dominant in their space across 16 global mega trends. And a final point, and I think very importantly, is that that's all great, but risk management is also equally important. So, when we structure the portfolio, these 30 stocks, you're already getting diversification across the 16 global mega trends, but we also seek to try and understand, the correlations and covariances between these stocks to ensure that we're managing the risk and also trying to maximize the returns at the same time.
Just quickly, just given the sectors you're excluding, are you managing against a benchmark, a broad-based benchmark?
Yep. So we still, it's the standard benchmark. It's what all investors, when they're investing globally. So that's right, Nigel. It's the MSCI All Country World Index, excluding Australia. That's correct.
Right. Thanks. Stephen?
Thank you, Nigel. Well, our investment approach is to own high-quality wealth-creating businesses. And for us, high quality means a few characteristics. Firstly, businesses that have been around a long time, which is particularly relevant right now. There are many companies where this is perhaps the first difficult period, certainly their first inflationary period they might have encountered. Number two, businesses that operate in growing markets. Number three, businesses that grow faster than their markets. If you're in a growing market and just growing with your peer group, perhaps there's something very special about you. We're looking for the very special businesses that outgrow their peers, consistently take market share. We want businesses that are all-weather businesses, earn high rates of return in all scenarios, rather than those fair-weather businesses that might have great 5 years and give all those earnings back in year number 6. And then conservative balance sheets, and lastly, management that operate the business conservatively. And that gives us confidence that we own a business that 5 years and 10 years from now will be significantly more valuable. So as owners of these businesses, we're participating in the wealth creation that comes from their growth. Now, the higher you set your hurdle, then the fewer the stocks that get through it. And we like our hurdle rates to be very high, which is why we own a maximum of 15 businesses, which allows that intersection between a variety of quality attributes and price, because ultimately price will have an important role to play in your investment outcomes. And applying this to our managed accounts, it's very simple. We have a single strategy. So every portfolio looks the same. Our strategy is available via unit trusts, and we have more than $200 million available today via various managed accounts. So it's one strategy applied through multiple implementation options, of which managed accounts is one. Lastly, we're deliberately transparent, so we're quite comfortable with people through managed accounts seeing every stock in the portfolio, because since our inception, we've disclosed every stock that we own. So we're unusual in our concentration, our quality criteria, and our transparency.
That's very clear. How quantitative is your process? I mean, you've got a pretty small team, so in terms of screening stocks out, that'd be pretty important, right?
Well, the screening process is an important tool. It's a tool, not a rule. It can also be quite a blunt instrument. So it can help you find businesses that are very profitable, businesses that have been around a long time and have strong balance sheets. But ultimately, that's only ever the rearview mirror. And so then we have to combine that quantitative assessment with very much a subjective qualitative assessment. And at the end of the day, we're in the business of making judgments, and you can't robo judgments. You can apply mechanical algorithms, but prospectively, it's all about judgments. So history will inform our judgments, which is why we like businesses that have been around a very long time. The longer the history, perhaps the more information content it conveys into those forward-looking judgments. But we're looking for quantitatively very strong businesses and applying some rigorous subjective qualitative assessment.
Good, we'll explore that further in the discussion. Now, turning to thematics, which is a widely used approach among global equity managers, or has periods of being in fashion and out of fashion, I should say. Now, Monik, you mentioned global megatrends, so I think you're best placed to start answering this question. What is the role of thematics in your investment process, and can you include a stock and sector example?
Absolutely, thanks, Nigel. So, I think there's clearly a lot of themes and fads around, and we understand that. And I think that's very different from the way we look at megatrends. And really, you've got to define these terms within your own process rather than being very broad and generic about it. So there's hundreds of fads and themes out there. We've seen a lot of them go through a lot of challenges the last 2 years because a lot of them were unprofitable. They're shorter term in nature. And really, that's very different from megatrends, which are really large, durable and unstoppable long-term trends with profitable industry structures. So that's our definition of megatrends. And examples of that include, the move to contactless payments. That just keeps moving on. Very profitable industry structure. The sustained rise in pet expenditure. There's multiple drivers behind that. The aging of the population and the acceleration in chronic diseases. I mean, the over 70-year-old cohort is actually accelerating. Everyone's been talking about the aging population, but it's actually aging very quickly now. That's what our demographic study is showing, the adoption of alternative energy sources clearly to combat climate change. So these are just some of the 16 megatrend examples in their portfolio. But just to dig a little bit deeper, I'll go into one of them. And a good example, which we've had in the portfolio for a while, is what we call the pet humanization megatrend. And what that is essentially, so we're increasingly treating pets like humans. And what's really particularly attractive about that is the Gen Zers are the first generation that have actually grown up truly treating pets like humans. And Gen Zers is basically anyone who's sort of born around 97, 98 till around 2012. And in a post-COVID environment, what's actually happened to the growth in that industry is that prior to COVID, it was probably growing at around 5% per annum. And that has now accelerated to 7% per annum. And what really gives us confidence in the megatrend, I'll just get into a stock shortly, but what gives us really confidence in the megatrend is that, the Gen Zers, as I said, who are the first generation to fully embrace pets as humans, well, there's going to be 1.8 billion of them within the next 10 years. They're going to be the largest generational cohort, and they're going to make up probably the largest part of the working population. And all the surveys actually showing, and this is what we do a lot of detailed work, trying to get information, collaborate, and trying to get the industry size and trying to understand the trends and the growth in trends. And all the surveys are showing that they're seeking to spend much more on pet expenditure than all prior generations. So really important driver. Two other additional drivers are the number of single households are increasing. So, pet adoption is increasing. And the growing middle class in emerging markets, I know that's sort of a trend that's been around for a while, but there's 1 billion Asians that are joining the middle class, more coming from India over the next 10 years. And interestingly, today, there's more pets in China than there are in the US, okay? So multiple drivers there. But the stock that we own, which is worth highlighting, is a company called IDEX Laboratories. And really, all of you who are familiar with the Australian equity market, they're like the Sonic healthcare of the pet industry, but significantly more profitable. Okay, they offer everything that vets need to test your pets for all manners of ailments. The company provides equipment to use, used to run diagnostics tests, a bit like Sonic does, but for pets, as well as the testing kits. But again, that's all well and good. Great mega trend, but it's not just about the trend. Okay, it's bottom-up work. We do a lot of financial modeling. We get into the company, the industry structure. It's great to have a great story and a narrative, but the data has to support it. Now, if you look at the return on invested capital of IDEX, it's close to 60%. All right, the average in the market is 13 to 15, 4 times the market average. So as I said, the cross-up portfolio is 40%. But what's that's a ROIC, or return on invested capital, is a sort of a static measure. What are they actually doing in terms of the incremental return they're generating, all the capital they're reinvesting? Well, they're getting a return pretty close to 60 still. Okay, so that's what's going to deliver compound earnings growth. And as I said to you earlier, a foundational premise is that share prices follow the sustainable earnings growth of a company. So here's an example: reinvesting a huge amount of the retained earnings, getting a high incremental return, powering those earnings forward, which we think will be growing at a minimum high single digits, if not low double digit rates, for many, many years to come. So there's the stock example, within the mega trend. So I think that's I think the other final point I'd like to make is that, across the 16 global mega trends that we have in the portfolio, it really is a blend of both non-technology and technology. So, there's quite a nice mix in there.
Sounds very interesting. I mean, just do you have a mid to small cap bias because of that focus on a wide range of mega trends with high ROICs?
Yeah, good question, Nigel. I mean, obviously, with a lot of the established players, they have tended to be around, so we don't look at new companies. We tend to avoid IPOs, etc. They have been around for a while, not necessarily 40, 50 years. Some have been around for 10, 15 years, but they're some of the most profitable businesses out there. So it's really the dominant players, and the dominant players could be in the mid cap space or the large cap space, and that's where we tend to focus. Very little in the small cap space. So typically we say anything more than 2 billion, but really the smallest size has been around $7 or $8 billion. But it's been a very dominant and profitable company, and that's what's attracted us to that business.
Okay, good. Hugh, how does PPM think of thematics?
Well, I guess it's one element in the search for attractive, maintainable returns. The philosophy provides some guardrails around how much we pay and what sort of risk we're taking in investing. And you can look at time series that provide us some guides to what we think the maintainable rates of return are going to be. But it's best to actually fish where the fishes are. And a thematic approach is really just trying to look at where we think these returns are going to come from, and where we should start to look into the more quantitative aspects. And we're looking for attractive environments, and it's a range of factors. It's not only growth. There's the nature of in an industry, what the competitive practices are in the industry. There's a lot of sort of Porter analysis in this. We're looking for industries where we think there's going to be a long-term excess return, and it might not be massive returns on capital invested. And if we can achieve a return of 15% to the client, then I think we'd be very happy with that. And that's I think is a pretty long-term, pretty high long-term bar to jump. So I guess what there's a range of themes that we're perhaps looking at, the growth in semiconductors, The one I'd like to talk about though is in healthcare, and as I think that Monik observed, we're very wealthy. The amount of wealth that's been created in the last 20 years or so is just extraordinary, and it's reflected in people humanizing their pets. A visit to the vet can cost you more than to your doctor. So what we're looking at in healthcare is that obviously the populations are aging in developed countries, but they're also very wealthy, and they have the capacity to spend on their health, and their health is something that is foremost in everybody's mind. I think you look at the range of vitamins and all sorts of things that people will spend enormous amount of money on. What we're also looking for, though, is the barriers to entry and the ability to maintain rates of return on capital. And one of the areas that we think is very attractive is our hospital franchises. They're the one that we're invested in, Universal Health Services. It's a large US, mainly US hospital system. They have a long history of a high and consistent return on capital. They deploy their capital very carefully. It's got all the characteristics we're really looking for. And occasionally things come along when you get a chance to buy it at an attractive price, and that I think is the other aspect of our philosophy. It's a return that the investor is actually getting, and during the last year or so, the economics of hospitals have been severely disrupted by the cost of, particularly of nurses. But we don't think that's going to be a long-term thing. So we feel that we've been able to invest in a very attractive business at a very attractive price. And I think that's the themes that we're looking for is not only those that are growing very strongly and having a high returns, etc., but also that we can enter them at attractive prices and be confident that those characteristics will be maintained over time.
Just as a boutique in Australia, getting an insight into the US regulatory system in healthcare, I imagine that's a bit of a challenge.
Well, that would have, I think that's probably the case, sort of 15 years or so ago. Now the information is so easily disseminated that there's not everybody's a long way from somewhere, and you can access information just as easily from Sydney as you can from Edinburgh or Hong Kong or Nebraska.
Okay, Stephen, what do you think of? Do the Aoris consider thematics?
Look, our premise is all really all based around quality as we define it. So we spoke about businesses that have been around a long time, that are consistently profitable, that are competitively winning, and conservatively financed and managed. So a good example of that is L'Oreal. They were founded in 1909 with foundations in the professional hair care market. The business is very broad, and with breadth comes robustness. They operate in every beauty channel, in every beauty category, in every country in the world, which has been very valuable through the pandemic. It's a business that historically has got a long record of growing a bit faster than in its attractive market. It's taking a little bit of share every year. But what's really interesting, and a feature we've seen right across our portfolio, is that through the pandemic, the challenging periods of the last 2 or 3 years, the best businesses pull away from their peer group at an accelerated rate. To give you an example, in 2021, the global beauty market recovered by 8%, L'Oreal grew by 16%. So an outperformance gap that historically was 0.5 to 1% blew out to 8%. And in 2022, so far in a market that's grown by 6%, they've grown by 12%, and at profit margins that are higher than what they were earning a year ago. So I think L'Oréal really embeds these attributes that we're looking for, which is durability, consistent high levels of profitability, competitively winning businesses, and we're participants in that long-term wealth creation.
So are you relying on company management to pick changes in trends, changes in industries that rise and fall?
I think we like businesses where the industries are mature and the competitive structure is relatively mature. We don't have to pick the winner. We can look forward with confidence. And our view right across the portfolio is that we own businesses that 10 years ago were the leaders in the market. Today, they're leaders by a larger margin, L'Oréal being a good example. And as we look forward 5 and 10 years, we expect them to continue to strengthen that leadership position. So for those reasons, we don't get interested in markets like electric vehicles, because 10 years from now, who knows who'll be the leader? Who knows what regulatory subsidies that there'll be? Who knows how much you'll have to price a car in order to make an EV a mass market car? Lots of unknowns, including leadership and competitive dynamics. We like those industries where we don't have to answer those questions.
I think someone earlier mentioned Porter's 5 forces or 5 factors. I think people these days talk about a 6, which is the sustainability or ESG as well. How do you factor that in, Stephen?
I think it's an increasingly important consideration. It's becoming important to consumers. It's becoming important to governments. It's becoming important to corporate customers. And I think we take a very deliberately broad view. It's easy to make a mental shortcut and think ESG is not just the E part, but it's the climate part. Climate considerations are very real, but it goes into labour practices, compliance with government rules, the way the board conducts themselves, how you treat your customers, how you treat your workforce. And in an age where information is far more public than it used to be 10 years ago, and people are much more sensitive to poor practices, it's very, very relevant. So we're hearing more and more about poor labour practices in the supply chains. It's got nothing to do with climate, but it's very real in terms of how the business conducts itself. Ultimately, it's a very important part of how we consider quality. It's important to the sustainability of a business's reputation in the market, their employee retention, their customer satisfaction. So it's very important, but it's a much broader, at least we take a much broader view of it than I think is often taken in the market, where it can almost be automatically reduced to a very narrow view of that, which is climate.
Hugh, what does PPM, how do you work on factoring sustainability or responsible investing into your process?
I suppose, I think, good managements rely increasingly on, or management requires increasingly on the the quality of the culture of the company, and I think that's that's something that we think is a very important thing to kind of look at. That in the governance sense, that would be how we would be really looking at it. I mean, I don't think I think sort of quotas on boards and quotas for management and stuff like that is probably a bit of virtue signaling, but how the company actually operates, and one of the great considerations, I think, is the sort of longevity of the management and the succession practices and things like that. That's probably an important thing that we look at.
Right, Monik, I imagine under your 16 global megatrends, there'd be quite a few related to sustainability and ESG.
Yeah, I mean, our approach is actually integrated. We think it is very important now because I think customers and consumers of businesses and products, everything actually are now making decisions based on many of those factors. We know that if someone has poor practices, be it environmental, social, or governance, etc., then customers will find out very quickly and they'll vote with their feet. So we think it's really important to integrate it because, if companies are going to sustain high returns on capital, then they need to be able to sell their services and products going forward in increasing amounts and hopefully also get better prices for it as well. So it's, and what we do is we rather than sitting here and having a discussion with opinions and going, well, okay, it's all right, it's not. We actually explicitly factor that into our valuations. So if something's a little bit risky, we go, well, it's one of many risk factors, by the way, that we monitor, but it's an important one. And we go, well, we've got to acknowledge there is a risk. It's a perceived risk. Well, we may have a slightly different view, but let's just take that into account. There's a lot of smart people out there doing a lot more work, which we rely on. We do subscribe to a lot of external analysis to help us think about this. And then we use it within our discount rates, particularly on the downside, not so much on the upside. So if something's got a slightly higher risk profile, we will factor that into our numbers.
Good. Okay, moving on to a point that was raised earlier by Hugh. Is there a comparative advantage in having an Australian-based global equities boutique? I mean, actually, Hugh, can you just continue from your point that information is available to everyone, even those in Nebraska, which hopefully we haven't offended anybody there.
Yeah, I mean, I think it's just a wonderful period for investment managers. The availability of information and vast amounts of data that you have access to is unprecedented. I mean, we started 25 years ago, and it was sort of days of hard copy annual reports that arrived in the mail. This is just a nirvana for the investor. The amount of information that one can get from relatively inexpensive sources is just extraordinary, and that makes it a lot easier for a decentralized investment management industry. You don't have to be in one of the centers of economic activity to actually be able to access as much information as they can anywhere.
Does that help to reduce the noise? So if you were based in New York or London?
Yeah, well, that's what John Templeton thought when he migrated to the Bahamas. But yeah, I think that's probably the case of it. Yeah, I don't know if that's terribly important, but.
Okay, Stephen, you've started a boutique relatively recently. There's a lot of other global equities boutiques, even in Australia, actually. So, what's the advantages that you see in taking that on?
Yeah, Nigel, we're coming up to a 5-year record, and look, deep into our thinking is how can we make the next 5 years and the 5 years after that as good for clients as the first 5 years has been. So I think there's significant advantages in being a boutique, but oftentimes businesses allow themselves to drift in ways such that their second 5 years or their second 10 years is not as good as the first one. So I think there are a few things that informed the way that we set ourselves up. One is, I think, being publicly listed is not a great thing for a boutique asset manager. So we are and will remain a privately owned business. I think there are many boutiques where becoming publicly listed has been the end, not the start of great things. Secondly is we are and will remain a single strategy firm. When fund managers are owned by banks or insurance companies or multi-boutiques, there's always a corporate pressure on you to grow, to create more products and manage more money, basically create more revenue. And we want to make decisions that can lead to the best long-term client outcomes. And in order to do that, then it being privately owned, but also being very clear about where those guardrails are in business operations go. So single strategy is the second. And the third thing is being FUM constrained. We don't believe that we can run well an unlimited amount of money for our clients. And so we've said that our capacity is 3 to 5 billion. And we've been clear in our public documentation about that number and how we arrived at it. So there should, were we to ever to change it, people could see that we're skiing off piste, if you like, swimming outside of the flags. So there are those three principles: being privately owned, being a single strategy business, and being FUM limited. I think will ultimately allow us to maximise the considerable benefits that we see in being a global equity boutique.
Are you getting good access to these company management in the stocks that you own? Like some of these stocks are pretty big, like Accenture, for example.
We get very good access. And I think there's a few things that help us. One is that we're patient. Two is we're long only. The person we're talking to knows we're not going to short their stock. And three, when we travel, people respect the fact that we've come a long way. We had surprisingly good access to senior management through the pandemic period when it was sort of Zoom and Teams calls. But in the last 3 months, we've done 3 overseas trips, and our access to the CFO, the CEO levels has been surprisingly high and consistent across all the meetings that we've had. So we're managing about $750 million today. We're never the largest manager that comes to see them, but they respect the fact we've come a long way. We're patient and we're long only.
Okay, thanks, Monik. Insync's been around since when? I was just going to ask you that.
2009. Yep, since 2009. So,
yeah.
Look, I came to Australia in '94 from London, and my observations over sort of the last almost 28, 29 years is there have been many world-class international equity managers that have sort of started boutiques over that period and been enormously successful and highly regarded, not only the domestic market, but the global market. So I think that's just testament to, I suppose, the quality of individuals that sit in Australia. I think, as Stephen said, the challenge is, some of them get a bit too big, and that specialized focus nature starts to disappear. So, some of the boutiques have become very large, and I think, you could testament to that is just looking at their longer term track record and the troubles and problems they've had. This is not just one, but 2 or 3 of the larger fund managers. So but I think certainly it's a very attractive place to look at strategies and get some really decent blending across 2 or 3 managers across the boutique. You've got to do a bit of work, but there's some really good strategies in place there. So the proof's in the pudding. Certainly, I think you mentioned, Nigel, the noise. I mean, I worked in London. That was my starting point for a few years. But then I worked in New York as well in the early days with Bankers Trust. Again, a very successful fund manager in the 90s, highly regarded globally when I was there. But I remember working in New York, and boy, was I overwhelmed. I mean, I was like in a spin, every day, brokers walking in, CEOs walking in. I didn't know whether I was coming or going, to be honest with you. I don't think I performed particularly well. In fact, it's when I left that my performance improved again. And I think what that shows is that, you can see the forest from the trees a lot better when you're further away from that noise. And I think that's actually a competitive advantage. And I think, the other key thing there is, certainly being close to our clients and being accessible. I think it's very important for Australian investors. So when you've got all the other attributes that, both Hugh and Stephen went through, and combined with some of the things I said, I think being an Australian and having access to us and being able to understand exactly what we're doing in more detail is definitely a comparative advantage too, Nigel.
And just actually on the Australian market itself, we've seen the internalisation, if that's the right word, in industry funds, and also the growth of ETFs. I mean, how have you adapted to those changes?
I think it continues to be an advantage to be in a boutique, because some of those strategies are starting to be commoditized. I think, and you're sort of seeing similar sort of strategies being adopted. So by going to boutiques, I think you're getting something distinctly different and unique. And I think the other thing, I think it's quite common within all of us that are chatting today is, we've got a lot of experience and we've built the foundations of our investment philosophy through a process of time and experience. And we're able to then bring that to the market in a very specific way. Whereas when you work for one of those funds, you do, and I worked for bigger end of town for many years, you are somewhat constrained in many respects. And we tend to be a lot more agile and focused. So it gives me greater confidence that there's a position for specialists, let's call them boutique managers, in any portfolio going forward as a result.
Right. Stephen, this is sort of related. What gives you an edge over the competition in the global equities managed account space?
I think what gives us an edge is that we have a single strategy, and managed accounts is just one way that we make it accessible. We're not a firm that has a strategy of owning lots of stocks and then has a carve out that we apply to managed accounts. So I think that's key. We're very transparent. So as in the managed account world, we're very used to showing all of our portfolio every month. It's a common sense approach. So when people see stocks in the portfolio and they read our philosophy, I think it makes sense. We apply that with a lot of discipline. We're long-term owners of businesses. So some of the tax consequences that can come through managed accounts from high turnover strategies, we don't have that problem. So it's a simple, common sense, concentrated approach. We're a single strategy firm, and managed accounts is something that we've got a long experience in doing already.
And in terms of performance and your current positioning, what are you offering clients or investors?
We target returns of 8 to 12% per annum over a 5 to 7 year market cycle. We've delivered that since inception. In fact, we've delivered above that. Our performance in excess of the market is about 4.2%, which just puts us in the top decile of a very broad universe of international managers. And we're confident that we can sustain that track record looking forward.
Right. Okay. Monik, your competitive edge and how's portfolios placed at the moment?
Sure. I think similar. Low turnover. If you're investing in sustainable mega trends and profitability, you don't have to keep shifting around. These are enduring, durable attributes. So obviously we do move things around a little bit if things get expensive or etc. But generally, it tends to be fairly stable. The other thing is, the team here, the three guys here, we actually all started in Bankers Trust in the early 90s. So we have some common foundational principles we work with. And between us, we have 90 years of experience. So, when we're managing our clients' money, there's a lot of experience that have worked through very different cycles. And I think that's important. And I think the final sort of edge before I come to the portfolio is that, the thing, we have very strong narratives around each stock and megatrend, which really resonates with the investors. So, it's great to have a portfolio, but when you can go to a client and take them through the stocks and try and give them that piece, they sit there and they kind of go, okay, I get it. It's not, you can go deep into the technicals.
Oops, seems to have left. Might move to Hugh while Monik comes back online. PPM's competitive edge and how's portfolio performance been, and how have you got the portfolio positioned currently?
I suppose the competitive edge really is that the philosophy is a simple one, and it's easy to implement, and thirdly that we've stuck to it, and that's been over 2.5 decades. Sticking to your philosophy is not as easy as it might sound, and particularly in periods when the markets are going against you in a relative sense, particular. I think that's sort of having simpatico with your clients is really critical in these points of time, because the strategy doesn't work particularly in highly speculative markets. You can't be sort of dragged into areas that you don't want to be in because of client pressure. So I guess the notion of the client actually understanding what they're buying is really important. And we spend a lot of time, and that's really good with managed accounts, because you can do so with the clients far more directly than with just a pooled fund. Get them to understand what they're actually investing in and when it won't work, which is something that we kind of explain. So I think that's probably the best, one of the best things we have, that we're not dragged into doing things that we don't want to do just because the expectations are different to what reality might be at the particular point in time. I guess how we position the market, position the portfolios now. Well, this is a really good time for us, because the pricing of what we consider attractive stocks, and we've been cut out of so many areas in the last 3 or 4 years, merely on pricing. It's just a really good time, and we're building up positions in well, I mentioned particularly in semiconductors that we wouldn't have been able to get with a QE of only 12 months ago. So we're in positioning the portfolios far more aggressively now than we were sort of 2 years or so ago. Returns that returns over the last year have been good, well above the markets, as a result of just a kind of a defensive nature of the way that we invest. The period immediately after the onset of COVID, when the markets took off, was terrible. It was and it took a lot to sort of stay with the strategy that we've had for 25 years, and eventually that has come around to being pretty good. But I think that if one, and I think both the other members of the thing have said, that it's being in a boutique relieves you of the corporate pressures, and and you're able to you're not part of a big conglomerate that where things are driven from a head office. You live or die by your own efforts.
Thanks, Hugh. Monik's just rejoined. We're coming up towards the end of the session, but Monik, the consensus seems to be that there could be another leg down here in global equities, driven by reduced corporate earnings, and as a recession is not really fully priced in, despite numerous signals such as inverted yield curves in the US, for example. But what's your outlook for corporate earnings going forward here in the next year or so?
Sure. Look, great question. I mean, our work certainly shows that the market has already priced in an element of earnings downturn, and that's what it typically does. So that's why the markets have already fallen in advance of, I think, what everyone's seeing is a potential risk. So, we're probably, and the other thing is it's incredibly negative. And certainly when we look at our portfolio, because it's sort of megatrend focused, they tend to be a lot less economically sensitive. So, we're sort of trying to separate the market from the stocks in a way. And the companies that we own, we're still expecting, high single-digit earnings growth compounded over the next sort of 3 years. So, from our perspective, the analysts are normally quite slow to reduce the earnings, but the market's already done the work. So, yes, there might be perhaps a little bit more period of volatility next year, but I think our view is probably more optimistic. And, the thing about megatrends is because they're long-term and durable, this is, the long-term earnings power of all the businesses that we own hasn't changed as a result of the temporary slowdown in the economy. And in fact, if anything, the pullback in share price from our perspective actually provides an outstanding opportunity, I think, to get into some really good quality businesses.
Okay, thanks. Now, does the audience have any questions? I haven't seen any on the screen. No, everyone's keen to get to lunch by the looks of things. Okay, we've provided all the answers. I think the panel's done a great job providing all the answers. Thanks, Hugh, Monik, and Stephen for your contributions. Most appreciated. And I'd like to thank the audience as well for listening. I'll just hand back to, here's a reminder coming through. Now, Friday's session is particularly exciting. Multi-asset managers talking about the role of alternatives, which is quite a challenging area in managed accounts. And as Toby said earlier, we've got Dinya Irani from Innova Asset Management, David Matasek from Atrium Investment Management, and Shane Hawke from Oriana Portfolio Advisory Service.